All right, so we can start. Good afternoon, everyone. Here we are again with a trade plan series. This time we'll talk about performance metrics. I see we are quite a few members here, 25 people. I'm pleased you came to this session. We'll talk about basically statistics. Statistics is a bit a dry topic, so probably you have some expectations or some idea, and I would like to hear if you have some special interest in the topic, or if you are working on something that you work with statistics, with monitoring strategies or systems. Do you have any special interest in the matter? Well, we will not talk about harmonics, although it has been. I heard the last part of Derek's session before mine, and there was a very interesting point he made before the close, where he talked to someone or insisted in having a series of 100 trades in order to provide some probability of success, and we will talk about similar things: how to analyze track records, and to analyze to cross-read statistics, and so on. So basically, this time I assure you we will have a smaller session. This time I have prepared only 20 slides compared to the 40 slides last time. So I guess we will have enough time to cover the topic. So basically, we will read a performance record, starting with the strategy that we have been developing in the previous webinars. We have been testing it as well. So we did the complete process from the conceptual level until the back testing and monitoring of that strategy. And today we will go a bit deeper into those statistical figures. At the end, we will have a brief interactive quiz on the topic, and hopefully a question and answer session. So, I'm asking about softwares for best statistical analysis. Well, this is a bit out of topic. And what I can assure you is that in our services section we will deal with software for that matter. But today we'll talk more about the numbers itself. So we may ask how important the topic is, statistics. Basically, I can tell you that it's a way to measure how long it's going to take to achieve your goals, or a way to quantify your edge in trading, or as a measure for other people performance. If you are interested in investing in a managed account, or following a signal service, and you have a track record and you want to analyze if that investment suits your profile, suits your financial capabilities, and so on. So you are able to process those data with the statistical figures. Moreover, setting statistical goals and defining probabilities of success is much more realistic than sustaining an illusory dollar return. Basically, when we start out, we want to make some money, and we project some figures, but a statistical goal in terms of, well, I want to enhance my win rate, I want to enhance my profit ratio, or my expectancy, or my profit factor, are much more realistic goals, which you can track a lot better by tweaking your performance, by following each trade, than simply simply imagining a dollar return, right? But on the other hand, statistics can also mislead if not considered in a proper context or if used partially, okay? Because many statistical figures are coupled with others, or many statistical figures serve to calculate other ones, so that they have to be read always in tandem, always related to each other, and never as a single figure. If you remember from previous sessions, we had this circle where we started with the ideas of this conceptual world, where we started to formulate some hypotheses, to formulate afterwards a trading strategy, the rules and conditions, setting the time frames, choosing the tools, everything. So we went up to the verification, and this the real application of the strategy. And today we are on this final monitoring stage before we close the circle and get back to the conceptual conceptual world, or to those observations that we can derive from the monitoring processes. And among all monitoring practices, there is the performance metrics, or the statistics, right? First, when we start by looking to performance, basically the eye catcher is usually the growth curve, or the balance curve, like we have here. This one corresponds to the strategy that we have been developing, this mechanical strategy that we executed in backtesting mode over 5 years, which has been discussed in previous webinars. And this was the result. And we might ask, when we start by seeing a balance curve like this, we may also ask about growth, about equity, right? Because what we see here is just the balance. The balance corresponds to the closed trade equity, so to say. These are trades that are executed and closed. But you may ask as well, when you see a growth curve or a balance curve, you may ask as well for the equity. Okay, the equity in this case would be the balance, the current balance, plus minus open trades. Okay, many times we have statistical records of trading systems or managed account services where you have the closed trade balance curve, but it doesn't show the true equity. It doesn't show if there are open trades, for example. And so sometimes if the provider, the service is serious enough, it will provide both curves, so that you can compare as well equity. You can see if there are any open trades in the negative territory. So in order to advance a bit further, to read that equity curve, there are a lot of statistics, and this table here that we see on the right side corresponds to the same strategy, and we see here there are many numbers. These are not all numbers that exist, but the most common ones. We see the number of trades on the upper side. We see that there are also break-even trades, and so the break-even rate is figures here. We have expected payoff, the payoff ratio. We have obviously the return rate. We have the start and ending date. We have average profit, the drawdown. In that case, it's the drawdown to the start balance, the standard deviation, and so on and so on. So these are the figures that we basically will study. So once we have seen the curve, the equity curve, or the growth curve, we start to ask us, well, how much gain is there involved, and how much pain in order to reach that gain, right? These are the most basic questions we want to know. when we examine the performance. And answering to the question how much gain, we have the return rate, usually expressed as a percentage, and referring to the drawdown, or referring to how much pain, we have the drawdown. Okay, the picture below shows what the drawdown is. It's basically a peak to valley figure in the curve, in the equity curve, on the growth curve. Okay, like here, the account went down from an initial start balance of 10,000 to 8,000. It recovered a little bit to 9,000, and it went to 7,000. So we have a drawdown. Afterwards, a bigger drawdown happened. It went from 12,000 to 6,000, a loss of 50%, and the peak, the 12,000 peak was surpassed. The account growth reached 1,500. So that peak to valley at that point is the maximum drawdown. The maximum drawdown is not a guarantee that the system or the strategy will not lose more than that in the future, but is a historical figure that in the past, this is the pain that the investor, the trader, had to suffer in order to reach a certain return rate. Okay, it's not a guarantee that it will limit losses, but it's usually used, especially in managed account services. It's usually used as benchmark to stop trading. If we reach the maximum drawdown, we stop trading and analyze what happened, for example. Okay. Furthermore, once we know what the return rate and also the drawdowns are, we want to better examine those curves, right? We want to better examine those curves, and here we see two examples on the slide right now, and the next question we could formulate is how many trades were executed in order to achieve that return rate. Okay, so we see the above curve comprises 24 trades, while the lower one is made of 133 trades for more or less the same time period and more or less the same return. Okay, at least in number of pips, not exactly the same, but more or less. So we see that it's not the same when you have a certain return rate reached with a small number of trades, because then the opportunity cost, for example, the opportunity cost is higher. We see on the upper curve that most of the gains here were made basically in three trades. The last three trades comprised more than half of or almost half of the returns. Okay, that is a huge opportunity cost, because if you are not executing the trades at that moment, you lose that opportunity very, very easily. While a strategy with a higher frequency has a lower opportunity cost. If you are not executing that strategy for a certain time, you don't lose so much of opportunity. Okay. As for the drawdowns, this it's worth to mention that there are many ways to express drawdowns. Okay. Basically, we see here several charts, and on the upper chart we see a very large drawdown, which lasts for more than 6 months. In the middle chart, we see one that is fairly shorter than the first one, and then we see below another curve with smaller drawdown. Okay, so the length of drawdown for sure is something you want to know. And drawdowns can be expressed as maximum closed equity drawdown, for example. This would be the drawdown expressing closed trades. Okay, so here you would have only trades which have been closed. You don't have an idea, or at least through that drawdown figure, you don't know if there are open trades in the negative or in the positive territory. You don't know that. But you have also the maximum equity drawdown, which shows that information. Okay, it shows the equity curve. The equity being the capital that you really have at that moment. If you close all trades in that instant, the equity is what you have, is the capital available. Okay. Then you may have another figure, another drawdown figure, which is the average drawdown. Okay, might be useful. For example, in this lower chart, you may do an average between these drawdown here, the first one, the second one, and then smaller drawdowns that happen at another one here to the right side of the curve. You may have an average drawdown. You may compare that average drawdown to the maximum drawdown, and while trading or while executing that strategy or system, you know that as far as you are between the average drawdown and the maximum drawdown, you are within your statistical benchmark. So nothing wrong is happening compared to the historical performance. Okay. Once you go above the maximum historical drawdown, then things change. Okay. As for the number of closed trades or number of trades in a drawdown is another metric which is useful. You may want to know how many trades are in a drawdown. You may want to know if a single trade caused a severe drawdown or even a maximum drawdown, or short number of trades, or if there are many trades, if the strategy was losing trade by trade. So that information will give you that figure will give you that information. Although you can more or less see it through the equity curve, sometimes you don't have the equity curves available, so you want to know the number of trades which are in the drawdown, or the number of trades needed to recover from a drawdown, okay, or the time needed to recover from a drawdown. So you can compare the length of the drawdown to the length of time the system of strategy needed to recover from that drawdown. Okay, and the figure below shows another metric, which is intra-trade drawdown, which is fairly interesting. You see here in this example, you see that we have a very robust ascending equity curve, but we notice that some of the trades, despite ending in a positive result, they were in the negative territory by quite many pips. Okay, so this is something you want to know in order to calculate your margin requirements. For example, you want to know how many pips you will be in the negative in order to comply with margin requirements set by your broker. Okay, so these are inter-trade drawdowns, and inter-trade drawdowns are very related, or are based on this figure here, which is the maximum adverse excursion or the maximum favorable excursion. You will see it in some softwares or some services will provide you with that information. Basically, the maximum adverse excursion is the number of pips that you are in negative before the trade turns into positive and reach the target, or it's close. And conversely, the maximum favorable excursion is the number of pips that a trade was in positive before it went into negative and was closed for a loss. On the right side, we see several examples of trades. For example, on the two right columns, we have the results in number of pips and profit and loss, and then we have this figure here, high and low, and this makes reference to the maximum adverse and favorable excursion. We see that the first trade on the table, we see that it reached a favorable excursion of almost 400 pips, and it was closed for 233, while being a negative for only comparatively only 52 pips. Okay, but if we go to the bottom of the table and we see the not the last one, but the last but one, then we see that the trade was in positive by 351 pips and closed for a negative minus 13. Okay, so if this happens too often, if you see in the trade log, in the track record, if you see too many trades like this, you want probably to analyze. You want to go to compare with a chart, and you want to see was there a strong or very drastic reversal in price causing this trade to close in a loss, or was there a possibility to trail a stop or to implement some rule in order to at least to capture some of those profits. If it happens just as a single occurrence, it all points to a strong reversal in the market. Okay, something the system is not prepared to, and it may happen. Okay, but if it is a common occurrence, then you may think in adopting an extra rule in your system in order to manage those stuff. Well, I'm asking about software. Well, basically the software I use in terms of backtesting, as we have seen in previous sessions, I export the data from the backtesting software Forex Tester, and I process the data then in an Excel or OpenOffice spreadsheet, okay, using other figures. But if you are into automation, there are many strategies. Many softwares that deal with automation, they deal a lot of times with these numbers. Specifically for maximum adverse and favorable excursion, I don't know any software that specifically addresses these needs right now. But I'm sure that is maybe not under this name. Okay, this is probably the official name, but you can usually find it in under another name. At least I've seen it. Like here we have on that right side. This is a capture from the mirror trading platform Tradency, and they use the high-low to designate the same figure. And a similar figure would be the maximum number of consecutive losses or consecutive wins. Okay, it's something also interesting in when you analyze a trade log trade by trade. You want to make sure that the losses are not too close together. If they are, they will cause drawdowns or even severe drawdowns. In that case here, we see that there are two bigger losses of almost 150 pips, but there are other trades in between with steady gains of almost 30, 40 pips in that range, which probably in the equity curve help to stabilize the growth or the equity curve. So we want to make sure that losses are not too close together. Okay, this is a suggestion. And when analyzing a return rate, especially if we don't have the curve, like in the example here below, if we don't have the curve in front of us, we want to know that if any of the trades executed was responsible for most of the gains or losses, like in this case. This strategy went from negative territory, it was practically in a deep drawdown, and it went up in 3 trades into positive territory. Okay, so this is something, well, you may want to avoid a strategy that has a so strong run up or recover from a drawdown. Because what happens if you are not executing the strategy in those 3 trades, for example? Then you never recover that drawdown. Okay, so and besides, there is also the possibility that those conditions that triggered those 3 trades may never happen again in the future. So even if there is a big gain, if this big gain is the result of a few trades only, well, or a trade under a very specific market condition, then probabilities are low that it happens in the near future. When we compare the results as we have put them with our strategy, the back-tested strategy we had in the beginning, we disclosed the win rate, the loss rate, and the break-even rate. Okay, this is something that we choose to do to separate break-even trades from win trades. Okay, because the strategy in its design, it has a trailing stop, not an automatic one, a variable trailing stop to break-even levels, which often triggers the trade to close at break-even. Quite often, almost 20% of the time. So we found it interesting to separate those numbers, to separate the break-even rate from the win rate, although technically a break-even is a winning trade. Okay, because you recover the spread, so you are already winning the spread, you are break-even. So technically it's considered a win. So you will see sometimes, most of the times, you don't have the break-even rate. It's under the win rate. And in that case, our strategy would look like in example B, where the 90% were summed to the 46%, giving a win rate of 65, which is fairly okay. Okay, 65. We may think, on the other hand, we think that a strategy with a win rate of 46% only is very low and, well, and not robust enough, not profitable enough. But if we look under the data and we find out that among those winning trades, there are a lot of trades with break even, then we might reconsider the strategy. Okay, fine. Basically, the win rate is we can calculate them in different, including break-even trades or not, and many statistical figures which use the win rate or the loss rate will be affected as well. Okay, so knowing how the win rate is calculated, you can also interpret better other statistical figures which use the win rate or the loss rate in their formula. Okay, this is not the case of the win-loss ratio. The win-loss ratio is basically the number of winning trades by the number of divided by the number of losing trades. Okay, a very common statistical figure. It's usually expressed in a ratio. So in our example A, our previous example A, the win-loss ratio would be 1.31 to 1, while in example B, where the break-even trades are considered winning trades, we have this number increased to 1.85. Okay. So if you have only this number, if you have only the win-loss ratio, you want to know, okay, I have a win-loss ratio which is 1.85 or even 2 to 1. That means the strategy wins 2 times as much as it loses, or at least in number of trades. But you want to know if among those trades, among those winning trades, if they are break-even trades or even if they are small profits. Okay, this is something you might want to know. There are strategies that have a very high win rate, for example, of reaching 80% or eventually from time to time surpassing 80%. But then you may find out that many of these strategies have a favorable excursion in their trades, and the trades are then closed for a few pips only after being in positive territory for a long time or for many pips. They are closed for a few pips, and statistically it's still a winning trade and still giving a win-loss ratio like 2 to 1, for example, but the quality of this win-loss ratio will be poor if many trades are small profits or even break even compared to the other trades. Okay, so we are speaking here of a strategy, of a performance which has also a big standard deviation. Okay, because if we are talking about scalping strategy, which goes anyway for small profits, it's probably not the case. Okay? But if we have a swing strategy, for example, that can be in the positive for hundreds of pips and remaining with positions remaining open for days and weeks, and many of them close for 5 or 10 pips, then something has to be adjusted. Okay. When we see, like in this example here, we see a strategy which is only 24% of the time winning. Okay, so at the first glance we may think, well, 24% is not that great, but then we see that the total pips is almost 1,500 pips. Okay, and so there must be something. If it wins only 24% of the time, but it's still able to accumulate pips, where is the answer? Okay, where is the answer? And that is the payoff ratio. Payoff ratio basically is the average profit per trade divided by the average loss per trade. Okay. In case you don't have that figure in the already processed in the information you have available, you can take the average profit per trade, which usually is a very common figure, and you can calculate the payoff ratio. Okay, any payoff ratio above 1.5 is usually a robust strategy. Okay, like in this case, the payoff ratio of this strategy is above 5. So it wins on average. It wins 5 times more than it loses, and there is the answer for this strategy being accumulative in terms of gains of pips, despite a very low or modest win rate. Okay, so we already see another example how these figures are coupled with another, how these figures need this interdependence in order to be interpreted, in order to be understood. Okay, so any of these statistical figures by itself can tell you anything, or it can give you some information that can be easily manipulated. Okay, so always ask for these finer statistical figures, and if you don't have them, try to calculate them based on the trade log, on the information you have available. If you want to know how many dollars are we likely to win for every dollar we lose, there is another figure called the profit factor, which is the gross profit divided by the gross loss. Okay. Typically, a good performance record should have a profit factor of 1.5. Okay. We had 2.1 in our backtested strategy. Okay. However, a very high number is alarming. The sample data might be not big enough, or the system might be over optimized. Okay. This is especially interesting for people dealing with automation, with expert advisors, and so on. This over optimization. So this is the profit factor is a number that can give us a hint. Okay, so if you are tracking your own performance, you will really need a substantial sample of data in the range of 50-100 pips in order to have a profit factor which really speaks about your performance. Okay, and the expected payoff is another performance metric, which in that case tells what is the expected gain or loss for each trade in absolute value. Okay, it calculates the total net profit divided by the number of trades, and provides a number which speaks about the profitability or unprofitability of the next trade. Okay, this is the expected payoff. So what you expect to gain or lose in the next trade. Okay. Yet another figure, similar but not the same, is the average profitability. Okay. So in case of a poor win-loss ratio, how can I know how profitable is a performance? Okay, and this is the formula. In case of our strategy, for example, the average profitability is about $20. Okay, so we calculate it. Here we see the win rate. Here we see the loss rate. Right, pardon. And the average profit and the average loss were also used. Okay, so average profit and average loss are again simple statistical figures that you have available in most of the platform. Okay, then there are time statistics. We could call them. These are statistics that speak about how the performance has behaved in time. We can ask, for example, how many trades per day, per month, per year does the system or the strategy print. Okay, in order to know if we can follow it, if we can execute it, or it could also give us a hint for the cost. Okay, if there are many trades per day, so the cost will be higher, for example. The average holding time, something that is interesting. The average holding time can be then also read among winning trades, among losing trades, so we can calculate, are the losses lasting longer than the winning trades? I'm holding losses for a longer time, or winning trades, or etc., etc. So the average holding time gives also an idea of what is the quality of the strategy. Okay. The drawdowns can also be expressed in time. The longest total equity drawdown, for example, or the maximum monthly total equity drawdown, especially in managed account services. They will provide you with a maximum monthly drawdown. Okay. As for the costs, there are certain numbers that speak about explicit costs, like total commissions or spreads. This is an explicit trading cost. The total slippage, or the total forex carry, the interest rate differential that you may have to pay, or that is credited to your account, is considered a cost and can be considered also a statistical figure and gives you information about the behavior of the strategy. Let me provide you with some links here. Okay, here are some links. The above one, the Learning Center, is where all these figures and more complex ones are explained. Okay, the images that we have used here for the presentation are mostly taken from a Trade and See mirror trading platform, which is available in the services section. This is the second link, and then we have a few books here if you are interested in the topic. May we go over now to a brief questionnaire, a brief quiz. So we still have a few minutes to go, and if you are ready, we can make this brief quiz on the performance metrics. If you are ready, it's about 10 questions. We have made it in previous webinars as well. So we could. What I will ask you is, I will show you some questions here in the quiz, and I ask you to answer them through the chat window, so that we can do it together. And in the final minutes, we'll examine the results that we got. Okay. So I will start the test. And the first question asks, if you attempt to raise your profit potential and reduce your loss size, all other things being equal, your win rate will probably increase or decrease. What do you say is the answer to this question? If you attempt to raise your profit potential and reduce the lot size, all other things being equal, your win rate will probably. We have 2 increase, 1 decrease. So I will choose, well, increase. Still we have 3 increase, decrease. We are equal. If I reduce the loss size, okay, if I reduce the loss size, increase, decrease, I think we have more, 1, 2, 3, okay, we have more increases, so I'll choose that one and submit the question. We'll see the result in a few minutes. A drawdown to start balance is only meaningful when the strategy is using the following position sizing model. It's a bit more difficult, okay? A drawdown to start balance is like we had in the first slide where we showed the backtested strategy. There we saw that the drawdown was related to the start balance, not to the equity, okay? This is sometimes you see it in managed accounts where there is initial minimum start balance, and the drawdown is related to that start balance. Okay, let's see if a minimum capital sum to execute a system is $20,000, for example. The drawdown will always be calculated in relation to this quantity. Okay, but this is only meaningful when a certain position sizing model is used. Okay. Okay, this is, well, if there is no answer, it's the fixed lot position sizing, okay? Because this is something that we will deal with in the next webinars, but with a fixed ratio or fixed fractional, the position size does not remain the same, so it will make no sense to provide that figure. Okay. Next one, some strategies let losing trades remain open and do not reflect them in the track record. What statistical figure reveals if there are open losing trades? The maximum closed trade drawdown, the maximum equity drawdown, the actual growth percentage, the maximum intraday drawdown, or the largest loss as a percentage of gross loss. There is only one single answer. Right, the maximum equity drawdown. Right. What does it mean in a system's performance when the largest winning trade as a percentage of gross profit is far too high? First, it suggests that only one trade accounted for the majority of the profits in the system. Two, it suggests that the largest winning trade was considerably below the average winning trade. Or it suggests that the system's expectancy is unsustainably high. Option 1, right? Correct. Well, I think so. Let's see. How is the peak profit before closing the trade called? For example, you may have a closed trade that lost 25 tips, but during the time the trade was to open, it made 100 tips profit at some point. The first, the second, or the third. The maximum favorable excursion. Sixth question. How is the average loss calculated? The average loss. Gross loss divided by the number of lost trades, gross profit by the gross loss, gross profit minus gross loss, or none of the above. The first one. Okay, let's see. The fourth. None of the above. The 1. Okay, 1. Seventh. What statistical figures are used to better understand the below win-loss ratios? We have the below win-loss ratios of strategy A and B. And if we want to understand better what is beyond that win-loss ratio, we want to examine the break-even rate, we want to examine the standard deviation, or the consecutive number of winning trades. In that case, 2 answers are correct. The one, yeah, and another one, standard deviation or the consecutive number of winning trades. We haven't dealt during this session with the standard deviation. We mentioned, but it's covered in the learning center as well. What measurement offers a deeper insight into a system's performance when pretending to compare the win rate and the payoff ratio? There is a hint. Payoff ratio is the average profit per trade divided by the average loss per trade. Is it the mark to market? Is the average profitability? Is the profit to drawdown ratio or the Kalmar ratio? Just one. Number two. 3, 2. Okay, so we choose number 2. Ninth question. What percentage of profits is required to recover from a loss of 70%? 33%, 70%, 233, or 900%? How can I recover a loss of 70%? Doing how much? 3? The number 3. Okay. Fine. 10th. When is it safer to risk more per trade? When the expectancy or the payoff ratio are high, or after a large string of losing trades? When is it safer to risk more? Is it safe to, how safe it is to bet on a larger size after a string of losses? Number 1. When the expectancy and the payoff are high. Correct. And the last question, which strategy has a lower opportunity cost when comparing 2 track records of 6 months length? The strategy with a higher number of trades or the strategy with a lower number of trades? Which one has a lower opportunity cost? A lower opportunity cost. Number 2. Let's see. Okay, we submit the answer and let's see our results. Yes, we passed the exams. Congratulations. And here we have the review, a brief review. Let's see, we failed that one. If you attempt to raise your profit potential, reduce your loss size, all other things being equal, your win rate will probably increase, right? This happens because many statistical figures are coupled. In this case, reducing the lot size may cause more traders to be stopped out as the stops are now closer to the entry level, while attempting to enlarge profits would eventually lead to lesser profits because of reversals in price. Note that risks increases the longer the position is open. Okay, then we analyze further. We see that we passed almost of them, but the last one we failed. Which strategy has a lower opportunity cost when comparing two track records of 6 months? The strategy with a higher number of trades. Okay, the higher number of trades, the lower the opportunity cost. The cost of losing a trading opportunity. Okay, fine. Now, that's it for today. We could end our session in time. Many thanks, all of you, for the attendance in this webinar. We see us next time in the webinar series, in the trade plan series. Thanks again for your attendance, and talk soon. Bye bye.